of profit booking is what we are seeing. But the big question is this kind of consolidation going to continue? And to answer that, we're now joined by Dharmesh Shah, Head of Technicals at ICICI Director. Hi Dharmesh, very good afternoon. Thank you so much for joining us today. Take us through what our chart's suggesting. We hit that 26,000 mark and then again we scale back. When do you think is the time when we'll hit that level and also sustain it?
So good afternoon, Anishka. Yes, definitely, I think so. The market after the sharp move from 24,500 to almost 26,200, what we see right now is something more of a retracement of this sharp rally which happened in last 1 month. So yes, I think so. The market seems to be some bit of a consolidation. We should not forget that we had already seen 1,700 points rally, and what we believe this is something good for the market. I think so. It makes the market more healthy. Any correction from here on. So 24,400, 24,500 remains to be the strong support which we expect to hold in this current corrective phase. Sorry, 25,400 is a strong support for the market, but eventually we expect Nifty to challenge the life high, which is again 26,300 by December 2025. So yeah, it's something a buy on dips market. We believe, I think so, market will be more of a stock specific as we are into the result seasons. But once we see after 15th of November, I think so, your BR election outcome will also be there. So after post all these events, I think so, Q2 earnings, we believe market should see a more of a directional move, and we should be looking for a target of 26,300 by December 2025. So by the dip should be the market strategy. As far as mid caps are concerned, yes, definitely the mid caps, which is again a darling of this overall market and has not performed in line with the expectation the way the large caps have outperformed. We believe the mid cap index also has been witnessing a falling trend line breakout, and that seems to be indicating the end of the corrective phase for in fact mid caps also. So yes, days are good going forward. Maybe in the couple of weeks we can see some bit of a consolidation, but this consolidation will make the market more healthy. So buy the dip should be the strategy going forward.
Hi Dharmesh, this is Ankita also joining in. Thank you for joining. Buy on dips is the strategy, and in fact, it has been the buzzword since the start of this year because we were expecting consolidation and muted returns this year. But you mentioned about the mid cap pocket. That's been the darling of the market because there has been a lot of FII selling as far as the large caps are concerned. So if the mid cap space is giving you comfort, what within the mid cap space gives you comfort, or where do you see the value?
So the overall, I think so. Medcaps, I think so. You go to stock specific. I think so. Banking, I think so, is one. I think so that is clearly outperforming even in this current corrective phase. Yes, PSU banks again. The 16 months of long consolidation breakout has been witnessed in PSU bank index. So yes, we believe I think so. PSU should do better going forward. Overall, I would say the financial should do go better going forward. And inside the PSU banks, Union Bank remains to be our topic. Now, if you look at the Union Bank chart, I think so. The stock in last 1 year seems to be forming a cup and handle pattern and witnessing a breakout above 154. Again, if you look at the particular quality of the Union Bank since post-COVID 2020, the stock has generally a tendency to correct 37 to 40%. Post such corrections, the stock has a tendency to make a new high. In this current corrective phase, also, if you look for Union Bank, the stock has already corrected 41% from the high. And we believe, I think so, the way the rhythm should follow, it should make a new high in the days to come. So Union Bank is something which we like inside the PSU banks, where we look for a target of around 168, keeping a stop loss of 138.
All right, so Union Bank is one of the picks that Dharmesh has. Thank you, Dharmesh, for that. And on